There has been a noticeable surge in discussion surrounding what might unfold when the COMEX gold and silver markets reopen after hours, especially against a backdrop filled with vault movements, rising Chinese demand narratives, geopolitical tensions involving Iran, fluctuations in the US dollar, and an increasing tendency to label every uncertainty as a potential black swan event. At first glance, this environment feels charged, almost theatrical, as if every tick in the market carries historic significance. That emotional intensity is not accidental. It is often amplified by content creators who frame the market open as a pivotal, once-in-a-lifetime moment. While there is nothing inherently wrong with building anticipation or engaging an audience, the risk emerges when presentation begins to overshadow substance. When viewers are immersed in countdowns, dramatic language, and high-energy commentary, it becomes easier to mistake atmosphere for evidence. In reality, markets are rarely that simple or binary. The idea that one overnight session will decisively confirm either a collapse or a massive breakout ignores the complexity of how financial systems operate. Instead of reacting to the noise, it is more useful to step back and analyze the underlying components individually, understanding what is actually happening rather than what is being implied. This approach allows for a clearer, more grounded interpretation, one that separates emotional momentum from actual market dynamics and helps avoid being pulled into exaggerated conclusions. To understand the current situation properly, it is essential to examine the setup leading into the after-hours open, because context shapes interpretation far more than isolated events. The regular trading session did not unfold in a vacuum. It reflected a combination of macroeconomic influences, including a stronger US dollar earlier in the day, elevated oil prices, and renewed geopolitical concerns. Gold showed signs of pressure under these conditions, while silver declined more sharply, a behavior consistent with its historical tendency to amplify gold's movements. Silver is often more reactive, more volatile, and more emotionally traded, which means that when uncertainty enters the market, it tends to exaggerate both upward and downward moves. This alone explains much of the observed price action without needing to invoke extreme conclusions. However, the narrative that quickly followed attempted to link this ordinary volatility to the inevitability of a dramatic overnight event. That leap is where caution becomes necessary. A market feeling tense or uncertain does not automatically translate into a system-breaking move. Volatility and instability are not the same thing as collapse. By recognizing that distinction, one can begin to see how easily normal market behavior can be reframed into something far more dramatic than the underlying data supports. The setup, therefore, is not a ticking time bomb. It is a complex environment where multiple forces are interacting simultaneously. One of the most persistent oversimplifications in current market commentary is the assumption that geopolitical tension acts as a direct and predictable driver for precious metals. The narrative often suggests a straightforward relationship. Rising tension leads to rising gold and silver prices, while easing tension leads to declines. However, recent market behavior demonstrates that this relationship is far more nuanced. For instance, higher oil prices, often driven by geopolitical risk, can simultaneously support inflation expectations and strengthen the US dollar. While inflation concerns might appear supportive for metals, a stronger dollar can exert downward pressure on them, at least in the short term. This creates a situation where the same catalyst produces conflicting effects across different asset classes. As a result, the market response becomes less predictable and more dependent on which factor traders prioritize at any given moment. This complexity is frequently overlooked in favor of simpler, more compelling narratives. Yet understanding these overlapping influences is crucial for interpreting price action accurately. Markets are not governed by single variable equations. They are dynamic systems influenced by competing forces. Recognizing this helps prevent the kind of rigid thinking that assumes every headline must produce a predetermined outcome. Instead, it encourages a more flexible approach, one that adapts to evolving conditions rather than forcing them into a fixed narrative framework. The discussion around COMEX vault activity represents one of the more grounded aspects of the broader narrative, but even here, interpretation often stretches beyond what the data can reasonably support. Recent reports indicated changes in registered and eligible silver inventories, including a modest increase in registered metal alongside continued movement within total holdings. These shifts are meaningful and worth monitoring, as they provide insight into how metal is being categorized and potentially prepared for delivery. However, it is critical to understand what these categories actually represent. A transfer from eligible to registered does not indicate the discovery of new metal, nor does it signal an immediate shortage. Instead, it reflects a change in designation, essentially a shift in how existing metal is classified within the system. This distinction is frequently misunderstood or ignored, leading to exaggerated conclusions about supply constraints. Additionally, a single daily report is merely a snapshot in time. It captures one moment within a continuously evolving system, not a definitive trend or forecast. Drawing sweeping conclusions from such limited data is akin to analyzing an entire economy based on a single day's activity. While the information is valuable, its significance must be evaluated within a broader context. Without that perspective, even accurate data can lead to misleading interpretations. The surge in Chinese silver Imports is another key element of the current narrative, and unlike some of the more speculative claims, this trend is supported by tangible data. Reports indicate that China imported an unusually high volume of silver in March, significantly exceeding typical seasonal levels. This increase aligns with ongoing demand from both retail investors and industrial sectors, particularly solar manufacturing. Such strong demand does provide a bullish backdrop for silver, reinforcing the idea that the market may be operating under tighter supply conditions than in previous years. However, it is important to avoid extrapolating a single data point into a permanent trend. Analysts have noted that part of this surge may be due to front-loaded purchasing or timing distortions rather than a sustained increase at the same pace. In other words, while the demand is real, its intensity may fluctuate over time. Recognizing this nuance allows for a more resilient interpretation, one that acknowledges the strength of the underlying demand without relying on extreme assumptions. A balanced view suggests that silver may indeed be in a structurally tighter environment, characterized by strong industrial use and renewed investment interest. This perspective supports a long-term bullish case while remaining grounded in observable data, avoiding the need for dramatic or absolute claims. Beyond the raw data and macro drivers, it is impossible to ignore the role that presentation plays in shaping how market information is received. The recent surge in attention around the after-hours COMEX Open was not just about charts or fundamentals, it was also about performance. High-energy live streams, countdowns, inside jokes, and community participation created an atmosphere that felt more like an event than a routine market transition. This format is effective because it taps into something deeper than analysis. It engages emotion. When viewers are immersed in a shared experience, chatting, reacting, anticipating, it becomes easier to internalize the idea that something extraordinary is about to happen. The brain shifts from evaluating evidence to participating in momentum. That shift is subtle but powerful. It can transform ordinary uncertainty into perceived inevitability, where every small movement feels like confirmation of a larger narrative. None of this means the information being discussed is inherently wrong, but it does mean the context in which it is delivered can amplify its perceived significance. Understanding this dynamic is crucial because it allows you to separate the value of the data from the energy of the presentation. In doing so, you regain a level of objectivity that is often lost in highly charged environments, making it easier to interpret the market on its own terms rather than through the lens of collective excitement. When stepping back from the noise, one of the most revealing observations is that both bullish and bearish arguments currently have legitimate foundations. On the bearish side, there are clear signals to consider. Silver has shown relative weakness compared to gold in recent sessions, the US dollar has demonstrated periods of strength, and elevated oil prices have introduced inflation concerns that can support higher yields, often a headwind for non-yielding assets like precious metals. At the same time, the bullish case remains equally compelling. Strong physical demand narratives, particularly from China, continued interest in safe haven assets, and ongoing geopolitical uncertainty all provide meaningful support for metals. This duality is important because it highlights the inherent uncertainty of the current market environment. When both sides can construct reasonable arguments, it becomes evident that the market is not operating on a single dominant narrative. Instead, it is balancing multiple competing forces, each capable of influencing price direction depending on how conditions evolve. In such an environment, absolute certainty becomes a red flag rather than a sign of confidence. The more someone insists on a guaranteed outcome, the more likely it is that they are simplifying a complex situation to make it more digestible. Recognizing this helps maintain a balanced perspective where the focus shifts from predicting exact outcomes to understanding the range of possible scenarios. Oil prices have emerged as one of the most influential macro variables in the current setup, acting as a bridge between geopolitical developments and broader financial markets. A sharp rise in oil not only reflects supply concerns but also feeds directly into inflation expectations. Higher inflation expectations can, in turn, influence central bank policy, bond yields, and currency strength, all of which interact with the pricing of gold and silver. For example, rising yields can make non-yielding assets less attractive in the short term, even if the long-term case for holding hard assets remains intact. At the same time, elevated oil prices can signal increased geopolitical risk, which may support safe haven demand for gold. This creates a layered effect where the same catalyst produces multiple, sometimes conflicting, outcomes. The market's response then depends on which aspect traders prioritize at that moment. If inflation and yield concerns dominate, metals may face pressure. If risk aversion takes center stage, they may find support. This shifting focus is what makes the after-hours open particularly interesting, not because it guarantees a specific direction, but because it reveals which narrative is currently driving market behavior. By observing how different assets respond in relation to one another, it becomes possible to identify the prevailing theme, offering insight into the market's short-term priorities without relying on oversimplified assumptions. Another layer of complexity comes from the ongoing discussion around de-dollarization and its potential impact. On precious metals, there is no doubt that global conversations about reserve diversification and alternative settlement systems are gaining traction. Central banks in various regions have been gradually increasing their gold holdings, and there is a growing interest in reducing reliance on the US dollar for international trade. However, it is essential to distinguish between a long-term structural shift and an immediate disruptive event. The narrative often presented in high-intensity commentary suggests that the dollar's dominance is on the verge of a sudden collapse, which would instantly propel gold and silver to dramatically higher levels. In reality, such transitions tend to unfold gradually, influenced by a wide range of economic, political, and institutional factors. While the direction of change may be clear, the pace is far less certain. This distinction matters because it affects how one interprets short-term market movements. A long-term bullish case for metals does not require an imminent breakdown of the dollar. In fact, overstating the immediacy of such an event can weaken the overall argument by introducing unrealistic expectations. A more measured perspective acknowledges that metals can perform well within the existing system, supported by diversification trends and ongoing demand, without needing a sudden and complete shift in the global financial order. Silver, in particular, occupies a unique position within the precious metals space, combining characteristics that make it both attractive and unpredictable. Unlike gold, which is primarily driven by macroeconomic and monetary factors, silver also has significant industrial applications, linking its demand to sectors such as electronics and renewable energy. This dual role creates a dynamic where silver can respond to both economic growth and financial uncertainty, sometimes in conflicting ways. Additionally, silver's lower price point and higher volatility make it more accessible to retail investors, contributing to its reputation as a more emotional asset. This emotional component is evident in the way narratives around silver often become amplified, with strong convictions forming quickly based on limited data. It is not uncommon for silver to experience sharp moves in either direction, even when the broader trend remains intact. Understanding this behavior is crucial for maintaining perspective. A sudden decline does not necessarily invalidate a bullish thesis, just as a rapid increase does not guarantee a sustained rally. Instead, these movements reflect the asset's sensitivity to changing conditions and sentiment. By recognizing silver's inherent volatility and the factors that drive it, one can approach the market with a more balanced mindset, one that embraces its potential while respecting its unpredictability. One of the most misunderstood aspects of market behavior, especially around high-attention events like the after-hours open, is the tendency to treat the first move as the definitive signal. There is a natural urge to believe that whatever happens in those opening moments reveals the truth of the market. In reality, the first move is often nothing more than an emotional clearing process. It reflects positioning imbalances, hedging adjustments, and the immediate reaction of traders who were either underprepared or overcommitted before the bell. Sometimes the market gaps because one region leaned heavily in a particular direction while another region is forced to adjust. Other times it moves sharply simply to punish the largest concentration of expectations. This dynamic is especially pronounced in assets like silver, where sentiment can shift rapidly. The idea that a single opening move can confirm a broader narrative is appealing, but it rarely holds up under scrutiny. More often, the initial reaction is followed by a period of reassessment, where the market tests whether that move has real support or was driven by temporary imbalance. Understanding this helps prevent overreaction. Instead of treating the open as a final verdict, it is more useful to see it as the first clue and indication of what the market is interested in testing, not what it has already decided. Looking beyond the metals themselves, the broader macro environment continues to play a critical role in shaping short-term price action. Dollar has been oscillating in response to shifting expectations around economic resilience and geopolitical developments. These cross-market interactions are important because they provide context for how capital is being allocated. When equities pull back and volatility rises, there is often an increase in demand for defensive assets, including gold. Each asset class influences the others, creating a web of relationships that can amplify or offset individual drivers. By paying attention to these connections, it becomes easier to interpret seemingly contradictory movements. What might appear confusing at first glance often makes sense when viewed through the lens of capital flows and relative value. This broader perspective reduces the likelihood of being caught off guard by moves that, while unexpected in isolation, are consistent within the wider market structure. Paragraph 13. For precious metals, this creates an additional layer of influence. On one hand, rising costs and inflation concerns can strengthen the case for holding hard assets as a hedge against currency erosion. On the other hand, the same pressures can lead to tighter monetary conditions if central banks respond aggressively, which may weigh on metals in the short term. This dual impact underscores the importance of avoiding simplistic cause and effect assumptions. A single development can have multiple downstream consequences, each affecting the market in different ways. Recognizing these secondary and tertiary effects allows for a more nuanced understanding of how events translate into price action. Rather than viewing supply chain stress as a direct trigger for higher metal prices, it is more accurate to see it as part of a broader set of conditions that influence investor behavior and policy decisions over time. Long-term price forecasts for gold and silver have also contributed to the heightened sense of anticipation, but they often introduce a subtle form of confusion when interpreted incorrectly. When major institutions or analysts project significantly higher prices over an extended period, those projections are typically based on structural factors such as monetary policy trends, fiscal dynamics, and global demand shifts. However, these long-term views are frequently misapplied to short-term expectations. It is easy to hear a bullish forecast for the next year or two and assume that the move must begin immediately or even within the next trading session. This compression of timeframes can lead to frustration and poor decision-making when the market fails to deliver instant confirmation. In reality, markets rarely move in straight lines, even when the broader direction is well supported. There are periods of consolidation, correction, and uncertainty along the way. Understanding the distinction between destination and path is crucial. A valid long-term thesis does not eliminate short-term volatility. It coexists with it. By keeping these timeframes separate, it becomes easier to maintain patience and avoid the emotional swings that come from expecting immediate results in a system that operates on multiple timelines simultaneously. Paragraph 15. At the heart of all these dynamics lies a deeper psychological component that often goes unaddressed but plays a significant role in how markets are perceived and reacted to. The combination of uncertainty, opportunity, and constant information flow creates an environment where emotion can easily override analysis. This is particularly true in highly engaged communities where shared beliefs and collective enthusiasm can reinforce certain narratives. When a large group of participants begins to interpret every development through the same lens, it can create a feedback loop that amplifies conviction regardless of whether the underlying evidence fully supports it. This does not mean the crowd is always wrong, but it does mean that consensus can become self-reinforcing in ways that obscure alternative interpretations. Recognizing this dynamic is essential for maintaining independent judgment. It allows you to step back and evaluate information based on its merits rather than its popularity. In a market as complex and fast-moving as precious metals, this ability to think critically and resist emotional contagion can be a significant advantage. It helps ensure that decisions are grounded in a balanced assessment of risk and opportunity rather than driven by the intensity of the surrounding noise. Another subtle but important distortion in high-intensity market narratives is the tendency to group unrelated developments into a single directional conclusion. When multiple headlines emerge ranging from refinery incidents to tariff adjustments, energy policy decisions, or legal rulings, they are often bundled together and presented as if they all point toward the same inevitable outcome for metals. This creates a sense of overwhelming confirmation, as though every corner of the global system is aligning in one direction. In reality, each of these factors operates on a different timeline and influences the market through different channels. A refinery disruption might affect localized supply conditions, while a tariff policy shift could impact trade flows or investor sentiment. Energy policy changes may influence inflation expectations, but not necessarily translate into immediate price movements in silver or gold. By merging all these elements into one simplified narrative, the complexity of their individual effects is lost. This oversimplification makes the story more compelling but less accurate. A more disciplined approach involves separating each variable, understanding its specific impact, and then considering how it interacts with others over time. This layered analysis may not produce dramatic conclusions, but it provides a clearer and more reliable framework for interpreting market behavior. A related misconception arises in how people visualize physical movements within the precious metals market, particularly when it comes to deliveries and warehouse activity. There is often an assumption that every reported change corresponds to immediate, tangible movement: trucks arriving, metal being loaded, and inventory physically disappearing at a rapid pace. While physical transfers do occur, much of what drives these reports is administrative in nature. Ownership changes, warrant adjustments, and classification updates play a significant role in how inventory is recorded and reported. This distinction is critical because it highlights the difference between perception and mechanism. When viewers interpret every data point as a sign of accelerating depletion, it can create a sense of urgency that may not reflect the underlying reality. The system is more nuanced, involving layers of financial and logistical processes that do not always translate into straightforward physical scarcity. Understanding this reduces the likelihood of overreacting to routine adjustments. It also reinforces the importance of context, as isolated figures can appear far more dramatic than they actually are when viewed without an understanding of how the system operates. By appreciating the technical nature of these processes, one can approach the data with greater clarity and less susceptibility to exaggerated interpretations. As the focus returns to the after-hours open itself, it becomes clear that its true value lies not in predicting a definitive outcome but in revealing the market's immediate priorities. The open acts as a convergence point where various influences, macro conditions, positioning, sentiment, and recent headlines interact in real time. Observing how prices behave during this period can provide insight into which factors traders are currently emphasizing. For example, a strong reaction to currency movements may indicate that the dollar is driving sentiment, while a response aligned with commodity trends could suggest that inflation concerns are taking precedence. This interpretive approach shifts the focus from prediction to observation. Instead of asking whether the market will rise or fall, the more useful question becomes, what is the market responding to right now? This perspective reduces the pressure to anticipate every move and instead emphasizes adaptability. Markets are constantly evolving, and the ability to read shifting priorities can be more valuable than attempting to forecast a fixed outcome. By treating the open as an informational event rather than a decisive one, it becomes easier to navigate the uncertainty that defines short-term trading environments. Taking a broader view, the current state of the precious metals market can best be described as one of ongoing tension balanced by adaptability. There are clear sources of stress: geopolitical uncertainty, fluctuating energy prices, evolving monetary policy expectations, and shifting demand patterns. At the same time, the system continues to function, with participants adjusting to new information and conditions as they arise. This balance between pressure and resilience is what creates the uneven, sometimes contradictory price action observed in gold and silver. It also explains why dramatic predictions often fail to materialize, as expected. Markets rarely move in a straight line from stress to collapse. They tend to oscillate, absorbing shocks and recalibrating along the way. Recognizing this pattern helps set more realistic expectations. Instead of anticipating a single event that resolves all uncertainty, it becomes more practical to expect a series of smaller adjustments, each contributing to the overall direction. This perspective aligns more closely with how complex systems behave, where outcomes emerge gradually rather than instantaneously. By embracing this view, one can remain engaged with the market without becoming overly reliant on extreme scenarios. Ultimately, the most valuable takeaway from this entire discussion is the importance of maintaining balance both in analysis and in mindset. The precious metals market currently presents a compelling mix of supportive fundamentals and short-term uncertainties, strong physical demand, structural supply considerations, and ongoing geopolitical developments all contribute to a meaningful long-term narrative for gold and silver. At the same time, day-to-day price movements are influenced by a wide range of factors, including currency fluctuations, interest rate expectations, and shifting sentiment. This duality means that both optimism and caution have their place. The challenge lies in integrating these perspectives without allowing either to dominate completely. By focusing on evidence rather than emotion, context rather than headlines, and adaptability rather than certainty, it becomes possible to navigate the market with greater confidence and clarity. The goal is not to predict every movement, but to understand the forces at play and respond thoughtfully as conditions evolve. In doing so, you move beyond the noise of dramatic narratives and develop a more grounded approach, one that prioritizes informed decision-making over reactive behavior and long-term perspective over short-term excitement.